I'm going to pass it over to LeaseQuery's product accounting manager, Emily Fish. Emily is going to lead our opening panel session today, where you can see we're going to be asking a variety of accounting professionals from the audit industry, the consulting industry, and we might have a special guest from LeaseQuery as well join us. And I will let Emily take it away from here.
Thanks, Jason. Hello, and thank you for joining us. I'm Emily Fish, your moderator for today's roundtable. We asked our audience to submit questions for our panel to discuss today, and there was quite a mix of topics to address. So we've assembled some of the industry's leading accounting professionals to talk through those topics. Panelists, if you haven't already done so, please turn on your cameras and come off mute. We'll start with introductions so you can meet our esteemed panel. I'll start us off. As I mentioned, my name is Emily Fish. I'm a product accounting manager here at LeaseQuery. Prior to my career at LeaseQuery, I was with Pier 1 Imports, where I was the senior manager of lease accounting and audit for 6.5 years. While there, I implemented both lease accounting software and ASC 842. Bryan, why don't you tell us a little bit about yourself?
Sure, thanks, Emily. My name is Bryan Sinclair, and I'm currently the Vice President and the Technical Accounting Practice Leader for RGP. And included in that practice is supporting our clients with lease adoption, as well as the support and selection and implementation of lease accounting software, including LeaseQuery.
Thanks for being here, Bryan. Cheryl.
Thanks, Emily. Hi, everyone. I am Cheryl Levesque. I'm a partner at DHG in our New York office, but I am also helping to manage our newly opened office in Chicago. I focus primarily on consulting services in the MDR, insurance, and financial services industries. I work with clients to deliver a number of different services, such as accounting, finance transformation, SOX compliance, and just project management oversight for software implementations. Specifically to 842, I've helped a number of both public and private clients with their adoption of 842, including assisting them with their lease solution selection and their implementation. I am one of the leaders here at DHG for 842 adoption. Prior to my time here at DHG, I did work with a Big Four accounting firm and then also ran an internal audit department for an insurance company. And with that, Jeff, would you like to take it from there?
Yeah, thanks, Cheryl. And I also want to thank LeaseQuery, obviously, for hosting today and everybody in attendance. We appreciate that. I think it'll be very informative for you. And yeah, so my name is Jeff Weinberg, and I'm the director in our consulting services group at Baker Tilly. And I, with Paul Dunn, our partner, lead our technical accounting, financial accounting advisory services group, which essentially has been leading clients and implementations and adoptions for new technical accounting standards such as ASC 606, of course, RevRec, and here Lease Accounting 842, GASB 87, and others. We also certainly help our clients post-adoption. One of the things that we'll talk about today is how important the post-adoption portion is, even after adoption, in terms of managing leases. And again, I appreciate the opportunity to speak with you all today.
Thanks, Jeff. Stephanie.
Hi, I'm Stephanie Parker. I'm a senior financial analyst at the Middleby Corporation. We are a commercial and residential food equipment company. So if you've ever seen MasterChef or even gone to like Domino's, you've probably seen our equipment. We're pretty much everywhere, which you don't realize until you start working here, that every restaurant that you sit in, you're most likely using a Middleby product, which is kind of cool. I was the lead on the 842 implementation here at Middleby, so we kind of started at the top and went down. And then now I manage LeaseQuery and kind of the go-to lease expert for our company.
Thanks, Stephanie. And last but not least, George.
Hi, everyone. I'm George Ozzie. First of all, I wanted to thank everyone for being here and for attending this webinar. I'm the founder and CEO of LeaseQuery. Prior to LeaseQuery, I worked in technical accounting and accounting research at a Fortune 500 company. And prior to that, I was an auditor, and I audited financial institutions, so banks and insurance companies. I have a wealth of experience in leases, obviously, and also in debt and M&A. I've done a lot of work as relates to that. And once again, and hopefully, we're gonna have a thrilling conversation on lease accounting here.
I hope so. Now, before we get started, I need to remind our audience that each accounting scenario is different, and the advice given today is in no way meant to be a directive as to how to apply these accounting topics for your unique situation. You should consult with your auditor or accounting professional to address your individual needs. All right, panel, you ready? Let's dive in. We've received quite a few, like, do I really have to do this? Questions from our audience. So Jeff, can you talk about who this standard applies to and their corresponding adoption dates? Specifically, there was a question about an exemption for small businesses. Can you speak to that?
Yeah, absolutely. Of course, I think we all ask ourselves every day, yes, do I really have to go through this process? And as you said earlier, as the FASB pretty emphatically in their recent board meetings, and there's no more deferrals. We don't want to be a decade down the road, for private companies and others, since publics have already adopted. So I think that was pretty telling. It's an interesting question. We'll talk about, again, who this applies to. And as you said, there was a specific question about, what if I'm a small business, or maybe I have one lease, right? We get that a lot, 2 leases. And so, unfortunately, not only is there's not really an exemption for small businesses per se, there's also not a low value lease exemption, at least in ASC 842. In IFRS 16 is a little bit different story. They do have that, I think, 5,000 or less. But one of the things we'll talk about a little later, so I don't want to actually steal from another question I know is going to be regarding materiality, right? So, even though, you may not be able to exempt out immediately, there certainly is materiality that we can look at and how that's applied, short-term lease exemptions, things like that. So as far as the adoption date, so after 2 deferrals, certainly publics have adopted with some exception, right, depending on new issuances and that kind of thing, but and SPACs, which we know are pretty prevalent right now. But for private entities, and again, we're talking about, entities that are not in the public not-for-profit, because there's a little bit separate adoption date for them in the deferral area. But for most, again, private companies, again, your adoption date is going to be fiscal years beginning after December 15th, 2021, so after yesterday. And so, if you're a calendar year entity, certainly many are, then 1/1/22 would be your adoption date. And technically interim periods, I guess, within fiscal years beginning after December 15, 2022. For the most part, I will say in that area for us, we have a lot of clients that are certainly trying to get adopted in January, basically, and kind of leading up to that, or have already adopted early, and others will do it during the year, just being aware of any kind of, interim external reporting requirements. One other thing just to note is that we have had also quite a bit of activity, especially healthcare and others that are not-for-profits that have conduit bond obligations that may be publicly traded. So interestingly for those, again, there was a little bit of deferral, but it's essentially fiscal years beginning after December 15, 2019, and then those interim periods. So we've seen a lot of that this year, as probably others on the panel have as well. And so obviously most of those clients are now in the process of adopting. So hopefully that helps.
Yeah, no, that's great. Thank you. So based on the question,
I will say, just as a, what the prior company I worked for, the controller kept saying, well, actually the chief accounting officer kept saying, because this has been going on since 2006, right? The EITF, the Emerging Issues Task Force, started debating this in 2006. They released a rule in 2010, where everything had to be capitalized. They changed that, and now finally in 2016, these rules finally came out. That controller kept saying, "I will be retired before lease accounting changes actually happen," and she kept saying it, and obviously, she's not retired right now. She's still working at graphic packaging. So the rules are here. Ladies and gentlemen, the rules are here to stay, right? If you are issuing GAAP financials, this affects you. If you have, even if you're a singly held entity, but you have debt in terms of going to a bank, if you have to go get loans or you have funding from a VC firm or a PE firm, you will absolutely have to comply with these new lease accounting standards.
Definitely. Or if you're even entertaining the idea of going public at some point.
Correct.
So based on the questions we received, it seems like many companies are finally starting to dig into the details of adoption. Identifying the company's lease population came up several times, and understandably so. This task can be really intimidating. So Cheryl, what advice can you give to companies who just don't know where to start? What are some possible strategies to ensure that they have a complete lease population?
Thanks, Emily. It's actually a great question because every client we talk to, whether it's a client or a prospect, they are struggling to say, how do I get my hands around this population? And, they generally may know what leases they have out there for real estate. Equipment becomes a little bit more muddier, and then embedded leases is like a free-for-all of who knows what's out there, right?
Right.
So when trying to get a complete population of leases, I really encourage clients to think first through a couple of questions. And it's really just to start getting them to think about, their organization and, where they may need to start kind of their search. So, the first set of questions, or the first question would be, how do you currently keep track of the leases you know about, right? How do you identify new ones if you enter into, say, a new real estate lease? What's that process? Where do those copies of the leases or even contracts for that matter reside? I think folks or clients underestimate the time it takes to actually locate and put your hands on these actual documents, depending on how good you've done as just keeping a repository. The second question is, which departments within your organization is actually able to enter into a lease and a contract with someone, with an outside party? A lot of our clients, that is not centralized, right? It's great if you're a company that everything goes through procurement or legal, and we have this great repository that keeps everything. You got a little bit of a leg up. But if you're not that and don't have that situation, you really kind of need to think about, well, who can actually enter into these types of agreements? I would encourage you to cast a wide net, because I'm talking about kind of our phased approach and what we recommend in just a moment, but it's definitely easier to start wide and then take people off the list if they really can't enter into contracts than to narrow your population to too small and maybe miss something. And then lastly, think about if you're currently having to disclose your lease obligations under 840, where do you currently gather that information from? So that can give you some insights into where to start. So once you think about all those questions, I recommend kind of a phased approach. We think that this has worked really well to help identify and even ensure completeness of leases, including embedded leases. So like phase one is what we like to call identification and review of leases and contracts. So that step one of that phase is really coming up with that list of departments that can actually enter into leasing contracts and scheduling a call with them to kind of discuss the requirement. And do that in non-accounting terms, right? Most of the people you'll be speaking with don't know what 842 is, right of use asset, lease obligation. And if you ask if they have a lease, they probably will tell you they don't. And so it's really about level setting, but level setting in a way that non-accountants can understand, and then getting them aligned that this is the process that the organization needs to go through in order to be compliant. And then step two, once you have that population of folks and you've done that kind of kickoff call, is actually to hold some working sessions with those departments that can enter into leases or enter into contracts. You can, as part of that working session, you talk about what leases they currently have, what type of contracts they enter into, what are the usual terms, where do they reside, those kinds of things. And we always get the question similar, or do I have to look at every contract and to make a determination if I need to include it for 842? And it depends, right? We generally see a lot of bucketing and being able to review contracts in a bucketed manner, but it really depends on your situation. And then like step three is get the contracts, review it against the criteria, and make those determinations. And I would encourage you, as you go through all this, is to document. If you're having to comply with SOX, if it wasn't documented, it wasn't done. So make sure you're just not doing these steps, but not documenting along the way. And then, from a phase 2 perspective, even after you do all that work, talk to all these people, you still can miss something. And that's where you see a lot of people doing some type of general ledger analysis to see, is there anything out there where we haven't talked about and we may miss something? And we like to look at a few different criteria. We get GL data, and we might look at pivoted on like vendor, description, payments over a course of a number of months, and then review that to see, is there anything that kind of screams that this might be a potential lease? Like, if you definitely are booking stuff to rent on your GL, then maybe you should be looking at it to make sure, is it really a lease or is it something else? Maybe it's misclassified. But doing that GL detail will also kind of help you make sure you've captured everything that's hitting your ledger, and if it's not material, you can definitely state that, but you at least know your population.
Cheryl, just a follow-up question there. What examples can you give to show like an embedded lease, right? What kind of contracts have you seen that indicate, okay, you know what, this might be a supply chain contract or something that actually have an embedded lease in it, just so the audience can understand how complex this can actually be.
Yeah, the most common two places, and is we see a lot in marketing and we see a lot in IT. If I give an IT example, if you have data stored on the server and that server is specified only for your organization, so it can't be used for anyone else, that's a good indication that not only there's an asset associated with that contract, but you also control that asset, because you are basically the only one that can save data into that onto that server. Then there's always the famous, I think the most common example is if you think about marketing and if you do a billboard or in that case, a lot of times those billboard advertisements, you think it's an advertising contract, but you really have control of that. And a lot of times those end up being embedded leases. So really the key there, right, is to, one, does your contract, whether it be a service contract or what have you, does it require an asset in order to deliver that service? And a lot of times those contracts, you're going to check yes. So you always probably most of the time going to meet that criteria. And then that's the second criteria about control. And if you're using substantially all of the output during the term, those potentially are ones where you could be either or, right? And so that's where you really need to focus on. I also would just throw out here, practical expedients are really important, because when you do your embedded lease review, if you elect the package of 3, you're going to utilize 840 to make these determinations. If you don't elect a package of 3, which probably is unusual, I'm not sure I know of anyone that hasn't elected a package of 3, you would use 842. So there's a little nuance there, but really focus in on those contracts and that second criteria of control.
Excellent. So that's a very important point that Cheryl just brought up. Whenever you have a lease, right, there's two criteria: identification of an asset, and that could be actually implied or not implied. It could be stated or not stated as an asset. And also control, right? So identification of an asset and control, that really determines whether you have a lease. We have a test on our site, LeaseQuery, that actually indicates whether you have a leased asset or not. So thank you, Cheryl, for that.
So to piggyback off of kind of what Cheryl was saying, I would say my first step for getting everything is just to take a deep breath. It's definitely intimidating at first, especially for my company. We were very decentralized in terms of leases. All the divisions kind of did their own thing. So from a corporate standpoint, it was very oh goodness, how are we going to get all these leases into kind of one spot? So taking a deep breath was number one. But then I would also say, Cheryl saying that she does it in phases, that was huge for us. It's similar to kind of like a fitness goal. Make yourself small goals and achieve them along the way, versus making this one giant task and it's just going to make everything super daunting. So I would start there. And then what we kind of did was we differently than what Cheryl said is we kind of took a big data dump. We went out to our divisions and was like, everything that you've submitted for our lease disclosure prior to this, give us all that data. And we partially did it that way just because we were fearful we weren't going to get some stuff. Everyone here is in accounting, and accounting is always last to know. So what Cheryl said is like, you're bound to miss something. You're going to miss it. Like, you can dig into everything that you want to dig into. Accounting is always last to know. And, you know, the business still operates. So you'll definitely have everything situated, tied up in a bow, and then someone will throw this lease in your face and you'll be like, cool, great, let me add that in there. So keep that in mind that, like, yes, you can find everything, but you may miss one or two, and that is okay, as long as you kind of have along the way created those processes for checks and balances and stuff like that. As daunting as this is, if you're kind of nerdy like me, I took it as an approach to kind of do a giant process improvement. We were able to add a little more policy and just kind of control. Now we have the capability of, I can pull any lease that our company has at any time, whereas prior to that, I had to kind of be like, well, you're going to have to wait a day because they're in Sweden and there's a time change and you're going to have to wait. Now I can just pull it and send it off to management, which is super nice. But yes, it is daunting. It is doable. And if you need to, the way we did it was we kind of took all the leases and we did look at each one kind of, but it did help us create those processes and those improvements going forward. So then once we did implement LeaseQuery, right from the get-go, we were kind of being like, this is what we're doing. This is how we're going to improve everything. Let's go forward. And we had some pushback from some divisions, which you're probably going to see just because change can be difficult. But once it was kind of done, and we've definitely gotten like in the swing of things, I mean, we've been in it for almost 2 years now, people are starting to appreciate it. I get a lot of emails kind of being like, hey, can I put this in a LeaseQuery? And I'm like, go for it. Use the system the best that you can. So it's definitely, like I said, daunting, but it's doable, and it's basically just a lot of information gathering. So take advantage of like Cheryl said, reach out to those departments that have the ability to do the leases and ask them questions on how kind of those, you know, the negotiations happen and stuff like that. So your policy that you're creating with this, you know, new requirement works with kind of how your business runs. You don't want to kind of have them disconnected. So it's daunting, but it's a really fun aspect in kind of process improvement.
And Emily, I'm sure we need to go on to the next question. I just want to piggyback one thing, because both Jeff mentioned it in the beginning and then Stephanie just talked about it. This is an exercise for adoption, but that's not where it stops. Like Jeff says, and you know, Stephanie mentioned about establishing the process. This will be ongoing, you know, after adoption, and making sure you have a process in place to continuously know as you enter into new leases or into new contracts and how those get evaluated. That's going to be key to stay compliant.
No, you're
Great.
exactly right. Thanks for calling that out. Did I hear someone else?
Oh, no,
I was agreeing with Cheryl.
Oh, yeah. And I was going to too on the embeddeds. I think we may be leading into the next question, and I'm not sure I can top what anyone said here. It's really great discussion on that. But you know, one other area that we've seen, and just to point out within the test identification test, is we discussed earlier, there's two tests, the identification and control test. So we have seen, in addition to the perfect two examples Cheryl gave, we see those quite a bit too. It depends on the industry, right? But for example, in healthcare, where you have an agreement for consumables, right? So maybe it's a ventilator where there's a purchase agreement for consumables, but there's actually equipment, and it looks like you're getting it for free, but you're really not. And so, you know, that is an area where we've seen, you know, clients have to go in and if, again, material, you know, look at actually doing standalone selling price allocation, back to 606 a little bit, to determine, you know, what value really should be attributed to the equipment over the term of the lease. And so that I point out because we do see this sometimes where we have, you know, product with equipment that's being used, and, you know, the equipment does need to be certainly looked at in that particular case, again, if it meets, you know, the criteria for the identification and control test. I think another area we've seen is kind of a little bit tangential to that example is canisters, right? You know, clients that have canisters of gas and other things they use in their business. And so the only other point I was going to add to kind of what the panel was saying is within the identification test, we do look to see does the supplier have substantive substitution rights, and that's a little tricky because it's not only the ability to kind of freely substitute, right, another leased asset, but also they have to have economic benefit from doing it. So what we're not talking about there is, hey, this copier is not working and we're going to replace it with the same model. We're really looking at, in the case of, use like the canisters, for example, are they stationary, right? Some of these are very large. Some of them are just, routinely being moved in and out, right, for the customer or the lessee in that case. So again, just kind of keep in mind within those broad, tests of identification and control, there are some abilities to look at, especially on the substantive substitution right issue for the lessor. Does this exempt me out of this being a lease? So anyway, just kind of stealing from the next maybe question, but.
No, I think that's great, Jeff. And actually, panel, with your permission, I'm actually going to skip the next question about practical expedience, just in the interest of time. We did get a couple questions about that, but wanted to let our audience know that if you're unsure of what the practical package of practical expedience is, we talk about it on LeaseQuery's podcast called Accountant's Angle, and you can find us on Spotify or by visiting our website. So there's resources there. So we're going to skip and go to talking about initial valuation. So first of all, I know we could talk about this, for an entire hour alone just on this topic. So let's try to keep it brief. But Bryan, what are the key inputs for determining initial values of the right of use asset and lease liability? Additionally, how does an entity transition from 840 to 842 when they have existing deferred or prepaid rent balances? And what about initial direct costs?
Great questions. So let's start high level first, and it's really kind of definitional a little bit from the 842 standard. Starting with the lease liability, and at commencement date, the lessee measures that lease liability at the present value of the lease payments over the lease term. So the key inputs will be your lease payments, the term, and then also most important, probably the biggest challenge for most companies to address is the discount rate used in that present value measurement. The standard requires that first you have to evaluate whether or not there is a rate implicit in the lease, unless it cannot be readily determined. Otherwise, you then use an incremental borrowing rate. Now, AC 842 defines that incremental borrowing rate as the rate of interest that the lessee would have to pay or borrow on a collateralized basis over a similar term of the lease. Now, this has been an area that's been challenged quite a bit and by the auditors, and so it can take a fair amount of work. Now, for private companies or non-public entities, there is a policy election available that permits them to use a risk-free rate. And that risk-free rate is typically a zero coupon U.S. Treasury instrument, again, using a period comparable to the lease term. Now, the FASB recently revised 842 to permit entities to elect a risk-free rate by class of asset, rather than the original release of 842, which required an entity-wide basis of applying a risk-free rate. So that will allow you some relief for those cases where you may not, may use a different rate. Kind of thinking then, so again, the lease liability is the present value of release payments over the lease term. Now, to break that down further, lease payments will include both fixed payments and variable payments that depend on an index or rate. Therefore, lease payments do not include any variable lease payments that do not depend upon an index or rate. Also, the lease payment also includes exercise prices of any options that the lessee may have to purchase the underlying asset, if it is reasonably certain that the lessee will exercise that option. Further, it also includes termination penalties if the lessee intends to early terminate that lease. And then finally, it also includes amounts probable of being owed under any residual value guarantees. That's important to know, it's probable of being owed. Now, again, I do want to mention that lease payments do not include those other variable lease payments that are not dependent upon an index or a rate, such as the CPI. And also, lease payments do not include amounts that may be allocated to non-lease components, unless you decide as the entity make the policy election to not separate those lease and non-lease components. So those are a lot of, it's a lot of information in terms of key inputs. Now, in terms of the right of use asset, that we begin with the lease liability. We'll then we'll add to that any prepayments that the lessee may have made prior to commencement of the lease. You would add in any additional direct costs, and then you would reduce that by any lease incentives received. So in that transition from 840 to 842, to the extent that you do have remaining deferred rent balances, those would be then adjusted through the right of use asset on the date of adoption.
All great information. So there's a lot of things to consider. Just anecdotally, we had a question come through, and I'm sorry to spring this on the group, but there seems to be a lot of confusion for smaller businesses on where they get that risk-free rate or that incremental borrowing rate. So could someone talk to that real quick, since we just talked about it?
Yeah, I can speak to the risk-free rate. So what I've typically recommended is go to the U.S. Treasury or the Federal Reserve site, I believe, that publishes the rate, the yield tables effectively. So you'll find the yield tables for a zero coupon U.S. Treasury, and you'll scan across the table to find a term that's comparable to the lease term itself. So that's one site. I'm sure that the panelists also have other sites they've used as well.
Yes, I mean that's certainly something that is challenging, especially for non-public entities, for private institutions. If you use the risk-free rate, while that's easier, as Jeff mentioned, you can just go to the website and find that risk-free rate. It's usually very low. And the way this works is the lower the rate, the higher the liability, right? So that's kind of the seesaw that you have to work around, right? The challenge with the way the risk-free rate, well, the rate is defined is they say that the boards say you should use your rate for collateralized debt, right? And most debt for companies are not collateralized, right? So you can figure out what if you have a line of credit or a lot of people try to use their WACC, their weighted average cost of capital, but that's really not correct either. That's really not accurate either, because your WACC, your weighted average cost of capital, includes an equity component, right? And you really should not include the equity component there. It should be whatever you as a company could go get debt for, if that debt were collateralized. So that's the challenge there. What we see people doing is figuring out, okay, what is just the borrowing component of our weighted average cost of capital, and adjusting it as if it were collateralized, right? It's a very challenging exercise, which is why there's that practical expedient of using the risk-free rate. However, please understand that the risk-free rate is going to be lower, which means your liability is going to be higher.
Great call outs, yeah. So, Jeff, you had alluded to this before. Are there exclusions for low value leases? And let's discuss materiality. So what is a common materiality threshold for capitalization, and how does an entity establish that threshold?
Very good questions. It said, unfortunately, in ASC 842, we are not availed of the low value lease exemption. We do have one practical expedient, I will say, for short-term leases, 12 months or less, that would allow you to essentially continue how you accounted for those leases, on a straight line basis under ASC 840 for all intents and purposes. In other words, you're not required to record a right use asset and lease liability. Now, the proviso there, I'm going to get directly to your answer, but the proviso on those, what we've seen is that What happens, for example, with month-to-month leases? Some clients look at that as a subset of a short-term lease. So when you have a month-to-month or sometimes evergreen lease, maybe you're in a lease holdover pattern. In a holdover situation where you're continuing to occupy the leased asset if it's real estate, or utilize the leased assets equipment. Those can be even more complicated, because it's not just a matter of saying, well, it's a month-to-month lease, 30 days, and so it's short term. What we've seen in many cases is, especially in the current environment, where companies may not be ready to commit to something long term, but they've been in a property, real estate, for example, for a number of years, and it's important property, and they're just in holdover. They're paying, the base rent plus some percentage on top. Those you might actually have to even determine an implied lease term for, because the reality is you're really going to be in that longer. You're just choosing to kind of wait to sign a group. So I say all that because there is that short-term lease exemption. Some are true month-to-month leases, some are short-term, and so that's one area where if that's what you had and that's all you had, right, you would certainly have limited work to do. I think outside of that, since there's no quote low value leases, again, the FASB did not really promulgate specific guidance in terms of materiality. It was more of a general materiality threshold and analysis. So there is interpretive guidance out there. We've worked with clients on that. Some obviously, I'm just saying like a copier lease, if you had a real estate and a copier lease, I mean, that may be obvious that may not be material, but to your point, I think, Emily, in this panel, you really have to look at the facts and circumstances of your portfolio, of the leases, the individual leases, and then collectively. And the things to keep in mind there, one of the, some interpretive guidance has looked at possibly using something similar to how you have a threshold for capitalizing fixed assets. But the challenge there is then you also have to look at the liability side, right? So again, there's some ways to balance that out. And one thing we would keep in mind is from a materiality standpoint, especially when you're thinking about liabilities, the right of use assets, you're not going to have a current and non-current portion, but you will on the liability side. So sometimes you'll be in a situation where, you will have a material adjustment, just on the current liability side even, right? It just depends in the nature of your leases, where they are in their terms, or the non-current. So I think, again, very specific fact pattern, there is the ability to apply some thoughtful materiality thresholds and guidance as you work with, either your advisors or obviously the audit teams based on how they look at that, so.
I want us to because this is this is something that comes up quite with relative frequency is this concept, as Bryan mentioned, of month-to-month leases, right? So Emily, I know you're kind of the moderator here. What did you have any month-to-month leases? And this is for Emily and Stephanie. Did you have any month-to-month leases, and what was your policy with evaluating if you were going to capitalize any liabilities?
I know in our experience, we tended to go month to month at the end of a lease. So we had our initial lease term. We may exercise options or amend for an extended lease term. But it was typically at the end of the lease term when there were extenuating circumstances. Potentially, we couldn't get all of our merchandise out of the store in a reasonable time, or there was some reason to hold over. But it was never for an extended period of time. It was never for more than a month or two. So we really didn't take that into consideration at the lease expiration. We kind of switched back over to more, an 840 approach and just took the rent on a month-to-month basis. What about you, Stephanie? Oh, I think you might be on mute.
Sorry. Typical Zoom problem, I guess. Okay, so usually we kind of end up with the same issue as where it's usually at the end, but we have somewhere it kind of starts out month to month. And from that point, we kind of go back to the division and tell them to analyze if they're real estate transactions. It's kind of like, how long are you going to be here for? Sometimes if they're month to month, it's strictly because we're in between places and you just kind of need a holding place. And if that's the case, then it's a short term. But I've had some come out and be like, well, we're going to be here for a full year. And then I'm like, well, then you're going to have to put them into the system sort of thing. And we're going to have to treat them as a normal lease. But usually if it's kind of equipment based, sometimes it's just kind of like the lease is ended and we haven't found a new, let's say like forklift that we like, that's at a price, that point that we need, but we still kind of need this. Then we'll kind of reevaluate. And I kind of tell them, let's reevaluate every quarter. If you still think that you're going to find something, this quarter will kind of take it as a month to month, but next quarter, if you realize, like, for example, with COVID going on, we're just not going to be able to afford to kind of buy something outright, then we need to switch it to kind of that full lease term and kind of get it processed properly, just because at that point we need to follow we've determined, hey, this isn't going to be something going away in a short-term basis. So it's kind of, we play it by ear depending on what the circumstance is, but so we've kind of had like a mixture of whether or not they stay month to month versus going into kind of that long-term 12-month or more kind of thing.
Okay, so for the auditors on the call, I'm sorry, I just want to make sure we're providing value to our audience here. For the auditors on the call, for Bryan, Cheryl, and Jeff, would it be reasonable to say, okay, you know what, we're not certain what these month-to-month leases are going to be. We're not certain what the lease term is. However, we feel like we may cancel within a year or within 12 months. So is it reasonable to say, okay, we'll just capitalize for 12 months and put that on our books, and as Stephanie mentioned, evaluate on a quarterly basis. So keep a rolling 12 months worth of, capitalize 12 months worth of our lease payments. Is that reasonable?
I think I'll defer to the other panelists too, but I do think you keyed on the point is, reasonably certain. I mean, in essence, these are almost like auto renewals, and it depends on the specific language, in the lease agreement. Some literally are just that, or it could be not even a monthly, right? It could be quarterly, annual, and you make that termination. So to your point, I think it's that reasonably certain is a good benchmark to say, okay, just like a typical renewal option, that maybe is a 5-year renewal option, right? After the end of a term, and you're making that determination. Do I include that in my lease term? And so I think we have seen that. We've seen some that go longer, right? Because the client says, hey, we're reasonably certain we have to be in this real estate lease, and so that's certainly good. I mean, auditors like to see that and to be able to substantiate it, like in the technical memo, which we have a technical memo with adoption, as we all know. And so I'll let others kind of add to that, but certainly to continuously monitor those. I mean, we have one client that has a very significant portion of these, and that was a significant audit issue to look at, right? With the external auditor was, okay, this may just be the nature of their portfolio, and it's hard to predict, right? And so, those were looked at particularly in a different way than another client that said, hey, we have a handful of these real estate leases, they're pretty significant, we're going to be in them for maybe 3 to 5 years, so we're going to sign a term, even though, as Stephanie indicated, we're in a holdover status. So.
And I would just jump in, the thing about reasonably certain, right? It's you got to be reasonably certain, but there's got to be some economic incentive, there, and it's really a hard bar to meet there. So I would say, Amy, every circumstances are different. I would definitely look at your history, and I'll just throw out an example where we came across this and where we've seen this a lot is, and I'll give one example, is they had several real estate leases. They've been in the spot 10, 15 years. In the last 2 years, they've been month to month. Well, guess what? They got those got put on their balance sheet because history kind of shows us, okay, you're not going anywhere. You've been there a long time. I mean, they obviously hadn't gone in current negotiations to try to get a new lease because the lessee and the lessor were just fine going as is. But, those facts supported putting it on the balance sheet. So I do think it's case by case, and looking at history is important. But then also when you're looking at reasonably certain, thinking about, is there an economic incentive to kind of, we can kind of use that same language when you're thinking about renewals, and if you need to include those, so I think those are all things you have to consider. It's definitely not a black and white issue.
I agree.
I was just going to add to that. We've seen leases, especially with real estate or land leases. There is an economic incentive for that company to continue to operate its plant that sits on that land, even though there's a series of 5 or 10 year options to renew. They really had to look hard and make a decision around that reasonable certain holding period to think that we are, our business depends upon running this plant. So our length of time we're going to hold this is really much longer than just one of the initial period or the initial term. So it's always a tough decision around that reasonable certain holding period.
And kind of adds to Cheryl's point earlier on too, as you said in that example of why it's so important to have this as a cross-departmental effort, and it's a great opportunity on implementations for accounting to now, work with other groups that maybe they didn't as routinely, and they're kind of ahead of that process now. So as you said, whether it's IT or some division or operations or real estate, legal. So we found that is it's been a nice byproduct for clients to have that kind of interaction.
Yeah, interdepartmental is huge. It's kind of definitely helped figure out the reasonably certain too. Like, the history may show 2 years, but you go to talk to management and then all of a sudden they're like, oh no, we're switching things up. And then you're kind of like, oh, okay, cool. I'm glad I asked the questions. So the reasonably certain is as difficult as it can be from an accounting standpoint. Sometimes when you're a little removed from the operational, depending on where you're at, it's kind of good to like wiggle yourself in and be like, hey, I need to know kind of our future stance in this, for example, building and stuff. And I know COVID kind of changed a lot of stuff here at Middleby. So it was very much a couple times I was like, hey, this lease is coming to an end. What are we doing? And it would kind of be like, oh, well, pause because we're switching things up. So it got interesting in trying to figure out the reasonably certain sometimes, especially when COVID was in the mix and stuff like that. So.
All right, panel. So shifting our focus from implementation to more now towards like day 2 accounting and how to maintain what we've already implemented. With our last 5 minutes, wanted to talk about the like administrative side of things. So Stephanie, when transitioning, right, we need to consider the administrative side. So we need to think about like GL accounts that may need to be created, and how those will roll up in your financials, how those accounts will be reconciled and in what frequency, how will transactions be reviewed and recorded going forward. So when you transitioned and then, in day 2 and maintaining, what are some process changes you encountered, once your company had transitioned?
So once we transitioned, we went from a very decentralized to kind of a more centralized aspect. And we're even going through changes now that we had to implement from the get-go. So our consolidation tool, I'm up at corporate, so I deal with the consolidation. We had to like relay to the company, hey, we're changing our consolidation tool in the next couple of years. So I need you to set up these type of GL accounts. Yes, we may not be using them right now, but come 2 years from now, I'm going to need you to use it. So you might as well start getting into the practice now. Some listen and some don't. Now that we're in that new tool and I need all those accounts set up, not all of them are there. So there's times where you kind of have to go back and really kind of dig into kind of some of the divisions. But kind of taking that step back when you're going into that day 2 or what you need set up, taking that step back to be like, what is kind of our dream? How do we want to see this? But then taking the next step of, okay, so what tangibly can we do? So that's why we kind of told our divisions from the get-go, split out these accounts, do it in a way that'll be functional for your operation, but here at corporate, this is what I need. And then we kind of let them create their process from there. We then do a quarterly kind of reconciliation. I secretly look at it monthly just to make sure everyone's on track. But I really dig in, come on the quarter month so we can make sure our disclosures and all that stuff are correctly. And then at year end, we take even more checks in the sense that, for example, our properties disclosure that we have for our 10K some of it comes from LeaseQuery because we have the leased buildings. So that'll be our next check to kind of get that completeness to be like, hey, you need to also fill out this report. This data comes from LeaseQuery. Is it correct? And there's been a couple times where I've come back and people are like, oh, we extended our building and I haven't put it in yet. And I'm like, let's go. We're going to have to change a couple disclosures now. So having those multiple checks is really big, whether it's, you have the GL accounts, but then you also have, those big disclosures that corporate is kind of in charge of. So although the GL is important and we kind of let our divisions kind of do their own thing because we have different ERPs throughout the company, but consolidation, we kind of lead from there where this is what corporate wants to see. You guys make your processes there and stuff like that. So did that answer that question? I hope.
Yeah, that's great. I know from our experience, okay. And I'm not over exaggerating when I say this, everything changed. What accounts we looked at, how frequently we reconciled them, how our transactions were recorded, literally everything. So to our auditors, is there any advice you can give for all these process changes other than documenting? Because we all know when you have to document everything, but just to ease into the application in day 2.
Yeah, I think our clients really see so much through implementation, to y'all's points, that many times that will naturally evolve into policies and process. The policy, of course, the technical memo, but really also the processes. And we obviously work with our clients to try to transition back to them. Sometimes it comes back. Everybody's so busy, and it is a lot of work ongoing. We're as accounting professionals, we do always deal in estimates, but we're looking forward now as much as backwards sometimes, right? As from a reporting standpoint in that, and some of the determinations like Stephanie and team has said here. So so I think, definitely start to put that in place. A lot of our clients are actively doing it. And I think one last point is be aware of additional GL accounts. There's going to be a new chart. It's not only the balance sheet, but also income statement related that can then tie back to the wonderful quantitative footnote disclosure report out of LeaseQuery, right? So.
Thanks for that.
And the only thing I would add to Jeff, I think he covered it really well, is, start early. Don't wait till after you adopt it to figure out, okay, how should my process change? To make sure you're thinking about controls are going to change. They're going to be different. They're going to be things that maybe are not applicable anymore. They're going to be ones that you do make sure need to have controls over, user access, just and things like that, and especially if you have interfaces coming back and through from solutions to your ERP. Those are all important. And to be honest, the other thing I would say is make sure, from a training perspective, you're training the folks that will be responsible for what goes into LeaseQuery or whatever solution you may have, or you're training the folks who have responsibilities for inputs, outputs, that come out of the process. And make sure everyone's really well aware of their roles and responsibilities come day 2.
Thank you. And, that's all we have time for today. Unfortunately, we did have some questions we didn't get to, but, hopefully we can answer those for our audience later on. Again, thank you to our audience for sending in such great questions. And I join our audience in thanking our panelists for sharing your invaluable expertise with us today. I appreciate you taking the time to speak with us. Back to you in the office.
Bye.
Bye. Thank you.